Imagine this. You wake up every Monday morning, and before you even finish your coffee, a dividend payment lands in your account. Not once a month, not once a quarter, every single week. That's the power of weekly dividend ETFs, and in today's video we're breaking down the safest ones you can own right now. So, if you want consistent income, predictable cash flow, and the chance to build a portfolio that literally pays your bills weekly, make sure to hit that like button, subscribe to the channel, and drop a quick, "I'm ready for weekly dividends," in the comments below. It really helps the channel and keeps us bringing you this kind of in-depth research. Now, let's get into the heart of today's topic. We're going to uncover the safest weekly dividend ETFs, show you how much income you can realistically expect with 500 shares, and reveal why these ETFs might be the missing piece in your income strategy. This is not about speculation or hype, it's about building a portfolio that quietly and consistently works for you in the background, generating income even while you sleep. By the end of this video, you'll know exactly which ETFs deserve a spot on your watch list, and how you can position yourself for financial stability through weekly income.
Let's start with something most people overlook. The majority of dividend investors chase monthly or quarterly payers, but weekly ETFs are designed differently. They pool together high-yield assets, rotate income sources, and structure payouts to keep cash flow consistent. The key, however, is finding the ones that balance high yield with safety. Because let's be honest, an 18% yield doesn't mean much if your capital evaporates in 2 years. So we'll focus only on ETFs with strong underlying assets, steady performance records, and manageable risk. The first ETF on our list is Global X Super Dividend US ETF, DIV. Now, this fund pays monthly, but paired with a rotation strategy, investors often align it with weekly income through multiple holdings. DIV tracks 50 of the highest dividend-paying US equities. What makes it attractive is its focus on low-volatility stocks, companies that not only pay consistently but also reduce the risk of massive price swings. Currently, DIV is yielding around 6 to 7%. That means if you own 500 shares at roughly $18 a share, you'd be investing about $9,000. At a 7% yield, that's about $630 annually, or roughly $12 every single week. It might not sound life-changing yet, but remember, we're stacking these ETFs strategically, and when combined, the weekly income becomes powerful.
But here's where things get exciting. The USOI ETF, Credit Suisse X-Links Crude Oil Shares Covered Call ETN. This one is a bit of a hidden gem for aggressive income investors. It uses a covered call strategy on oil futures, distributing cash flow in a way that pays weekly. Its yield often lands in the double digits, sometimes 15% or more. That means 500 shares, priced around $70 each, would require a $35,000 investment. At a 15% yield, you're talking about $5,250 per year. That's $100 every single week. And this is where you start seeing how a carefully chosen basket of weekly dividend ETFs can transform a portfolio into a true income machine. Before we move on to the next ETF, let me ask you, what would you do with an extra $100 landing in your account every week without fail? Would you reinvest it, pay down debt, or cover groceries? Drop your answer in the comments below, because I love hearing how you'd put this strategy into practice. It also helps build a conversation for everyone learning here together.
Now, let's look at the QYLD ETF, Global X Nasdaq 100 Covered Call. This is one of the most popular high-yield ETFs out there, and while it pays monthly, its structure allows you to align payouts into weekly cash flow when combined with other ETFs. QYLD writes covered calls on the Nasdaq 100, turning volatility into income. Its yield hovers around 11 to 12%. With 500 shares priced at about $17, your total investment is $8,500. At 11% yield, you're earning around $935 annually, roughly $18 per week. Not bad for a single holding, and it scales massively if you increase position size. Now, here's the real magic. When you combine DIV, USOI, and QYLD in a portfolio, you're diversifying across low volatility dividend stocks, oil futures income, and Nasdaq option premiums. Each pays on different schedules, but when layered together, you can essentially create weekly income streams. And the bigger your share count, the more predictable and stable your weekly paycheck becomes.
But we can't stop here. Safety is crucial. That's why the next ETF on our list is JEPI, JP Morgan Equity Premium Income ETF. JEPI is one of the most respected covered call ETFs, praised for its balance of strong yield, around 9%, and relatively stable capital preservation. With 500 shares priced at about $57 each, that's a $28,500 investment. At a 9% yield, you're pocketing $2,565 annually, or about $49 every week. Combine that with USOI's $100 weekly potential, and now we're looking at nearly $150 per week between just two ETFs. Let's pause here for a second. If you're finding this breakdown valuable, hit that like button and subscribe. It tells me you want more deep dives into income strategies like this. And I promise, the ETFs coming up next could surprise you with how consistent their payouts are. Alright, moving on. Another contender is RYLD, Global X Russell 2000 Covered Call ETF. Similar to QYLD, but based on the Russell 2000 index, RYLD diversifies your income beyond large cap tech and gives exposure to small cap volatility premiums. Yielding around 12%, with shares priced near $19, your 500 share position, $9,500 investment, could generate about $1,140 annually, roughly $22 per week.
Now, imagine this. If you held 500 shares each of USOI, JEPI, QYLD, and RYLD, your combined weekly income would cross $200. That's $800 a month, $10,400 per year, all while your core capital remains invested in diversified, income-generating assets. And remember, this isn't speculation. These ETFs use structured strategies like covered calls and dividend screening to deliver this cash flow consistently. Here's where I want to drive home a point. You don't need to chase unstable 20% yields to secure weekly income. The trick is in layering safe, diversified ETFs to create a portfolio that works like a paycheck. And the best part? You're in control. You can reinvest dividends for compounding growth, or withdraw them for real-world expenses. It's financial flexibility at its finest. Let's put this into a bigger perspective. Suppose you build a portfolio of 2,000 shares across 4 ETFs, say 500 of each. Your total investment might be around $80,000 to $100,000, depending on market prices. That could realistically produce $800 to $1,000 per month in weekly style payouts. For some, that's rent. For others, it's groceries, utilities, or even a car payment. For retirees, it's peace of mind knowing their investments provide steady income without having to sell shares.
Before we wrap up, let me hit you with one more thought. These ETFs aren't just income tools, they're psychological tools. Knowing that money is coming in every single week changes the way you think about investing. It shifts you from stress and scarcity to stability and abundance. And that's the true value of weekly dividend strategies. So, here's your action step. Start small. Pick one of the ETFs we discussed today, maybe JEPI for safety, or USOI for higher yield, and run the numbers. Ask yourself, with 500 shares, what would my weekly income look like? Then, think about scaling that across 2, 3, or even 4 ETFs. If you found this breakdown helpful, make sure to hit like, subscribe, and drop a comment telling me which ETF you'd start with first. I personally read every comment, and I'd love to know your strategy. And don't click away just yet. Check out this next video popping up on screen right now, where we dive into the top monthly dividend ETFs that can be paired with weekly ones to create unstoppable cash flow. Trust me, you don't want to miss it. And remember, it's not about timing the market, it's about time in the market, especially when your investments are paying you every single week. See you in the next video.